All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. Been a busy week.
Very busy. Yes, for sure. So we have a lot to talk to you about today. I think the Silicon Valley Bank story is definitely the big news of the day, which we will get to. But first, we did hear from Fed Chair Powell this week. He was on Capitol Hill testifying before Congress. So what did we learn from him?
Well, we've learned that inflation's not coming down fast enough to suit him, and that's not terribly surprising. I think what kind of got the market roiled a little bit was the whole faster, higher, longer. We knew they were going to stay higher for longer, and it was unlikely that rates would come down this year, which is some thought that was happening a few months ago. But he introduced the concept of even faster. So the market has been anticipating next week they'll raise rates 25 basis points, and then at the next meeting 25 basis points, and then maybe at the next meeting after that 25. So the funds rate is close to 4 3/4 right now, and we'd end up close to 5 1/4 to 5 1/2, somewhere around there. Now there's an introduction of a potential 50 basis points next week instead of 25. People are divided on this, but the bottom line is this: we got used to higher for longer. And he kind of brought in the idea of faster, even more. And that kind of rattled the markets a little bit. Inflation is not coming down fast enough. And so they have, when we have discussed this before, they don't have any fine-tuning instruments that they can just slowly slow the economy down so that would slow inflation down. They don't have it, basically, and nobody does. All they can do is keep raising rates to hopefully cut off dramatic high levels of spending. And Elizabeth Warren, the senator, gave Powell a little bit of a hard time. She said, you keep raising rates, a lot of people are going to get thrown out of work. Doesn't that bother you? And Powell's in a difficult situation. The short answer is they have two mandates. Their job is to keep the economy strong, job growth, but it's also to combat inflation. Job growth is still very strong. Inflation is out of control. They have to do something. They don't have a choice. So the only instrument they have is to raise rates to slow the economy. And Elizabeth Warren was, in my opinion, asked a somewhat unfair question saying, oh, doesn't that bother you? You're going to throw people out of work. And, he said, that's not our intention, but we are doing what we have to do to deal with inflation, which is what we're supposed to be doing. So it's a tough situation for him to find himself in.
Yeah, definitely. And we did get the February jobs report this morning, higher than expected job growth there. So what did we learn from that?
Well, it was a little bit of good news, actually. And the market went up pre-market. Job growth is still strong. It's better than expected. That's good. But the wage component, at what we call the average hourly wage growth for February, was much lower than expected on a month-over-month basis. That's good news, because we don't want wage growth is one of the most sticky components of inflation, and it's been a major problem. People keep demanding it. What the Fed's concerned about is that wage growth becomes embedded in the system, that every year people ask for another 8-10% wage increase forever, and that's embedded inflation. They don't want that. They want wage growth tied to productivity gains. So if productivity goes up, yeah, more wages. And that's the bottom line. So overall, this was a positive jobs report from the respect of for the Fed, for the economy, for the stock market. Job growth still strong, average hourly wage growth slow.
So Bob, like I said, big story today is Silicon Valley Bank. What's happening there and how is it affecting other banks?
Yeah, so it looks like they're going to shut down Silicon Valley Bank. This is an unfortunate story because it's a very important story about bank deposits and the competition for bank deposits. Everybody's going crazy about buying your treasuries or 6-month treasuries at 5%. I have been joking about my mother for 2 weeks. She called me 2 weeks ago. She went to her local bank and called me amazed. She was being offered something like 4.25% for a 1-year bank CD, and she hadn't gotten these in years. She's about to roll over a one-year CD, and she's very excited about this. And she said, "I heard about these 2-year treasuries. You can get 5%. How can you buy a treasury?" Now, when your mother, and my mother is quite elderly but very spry, calls you about bank CDs and 2-year treasury yields, that's what we call a yield top. When it's filtering down to the level of my mother, the whole world knows about it. That's like the same thing as a shoe shine boy talking about the stock market to his customers. Like, everybody is talking about this. So there's a very big issue about bank deposits and people taking money out and putting it into treasuries. The Silicon Valley Bank thing is a different story, but it's tangentially related. Unfortunately, it's not a great story to help explain this problem. So Silicon Valley Bank is one of those very particular banks that services tech companies, tech startups, venture capital companies. So these companies get a lot of money to do startups from venture capital and from the bank. They have accounts at the bank. And it's been tough. With interest rates higher, it's hard to raise new money. These companies burn through cash very fast. So they've been drawing down their cash in these deposits, in these accounts, to run their companies. So the bank saw shrinking deposits, and they hold assets against the deposits, but not a large number because they give out loans. No bank has 100% capital behind every single loan. You don't do that. That's not how banking is done today. So they had to go out and sell assets, which a bank doesn't normally do. That's a very rare occurrence. And lo and behold, of course, because bond yields are up, prices for bonds are down, the value of their bond portfolio was lower than what they bought it for. So they took a loss on the bond portfolio. That makes sense. Duh. It just doesn't happen very often. Banks don't have to sell assets like this. And of course, everybody noticed, oh, look, they just took a $1.8 billion loss here on this bond portfolio, which is not surprising. But then it got everybody worried about, my heavens, well, what happens if, depositors attempt to keep removing more? Well, this is a very particular bank with a very particular kind of depositor. Everybody started saying, oh, what about other small banks that are out there, or even regional banks? What if depositors keep taking money out, like my mother that I kept making fun of, and they have a deposit problem? Well, this is where the issue becomes really legitimate, because what's happening now is banks are going to have to start paying more money to their depositors to keep money. Or my mother, people like my mother, they're going to take out money and buy CDs or 2-year treasuries or 1-year treasuries. So the deposit costs for the banks are going to go up. Well, what does that mean? Well, it means they're less profitable. We call net interest income might have some problems. The margins they charge between what they can charge for loans and what they have to pay out for deposits, might get smaller. So that's a problem for the banks. So there is a legitimate earnings question for people like my mother in these banks. What happens when you take the deposits and you buy treasuries? Well, to keep my mother from buying the 2-year treasuries, they're going to have to raise the amount they give my mother. That means they're less profitable. That's a really good story. That's a story we've been concerned about for a long time, but it's not been a big issue. And all of a sudden, the Silicon Valley Bank thing, which, as I explained to you, is sort of tangentially related, but it's not really, because it has to do with the problems as some of the tech startups are having. That kind of has brought all of this to the fore here. So there's what we call deposit risk. There's another problem. Remember, the Federal Reserve is doing what they call quantitative tightening. There's less money in the system, and that means less money finds its way into the stock market, into bank deposits. They're pulling back a little bit. So this, what we call quantitative tightening, is also reducing deposits a bit. So the message here is there may be or may not be smaller banks that are going to have to pay significantly more, banks in general, to depositors. And you want to pay attention, if this gets a little wonky, but you want to pay attention to the size and the quality of the deposit base. Who's holding your deposits at this point? And Wall Street's already sniffed that out. The biggest sector decliner yesterday was the Russell 2000. Those are small cap stocks. And that makes sense because financial stocks, mostly small bank stocks, are the biggest weighting in the Russell 2000. Financials are about 1/4 of the S&P 500, 1/4 of the Russell 2000. Technology is about 30% of the S&P 500. Financials are half of that. So small banks make up a very large part of the small cap universe. And not surprisingly, the Russell 2000 is down the most this week. So this is a little long-winded, but it's important you sort of understand how these ripple effects occur.
Yeah, for sure. Thanks for helping explain that, Bob, because there's a lot going on today, and it'll definitely be interesting to see how it plays out going forward. So next question is a little bit different, but where is the best opportunity to invest right now? What are your thoughts there?
Let's go back to my mother again. I'm sorry to keep bringing up my mother. She would laugh if she heard this. The urge is to sort of throw money into short-term treasuries. I mean, I can't tell you how many people have stopped, even on the floor. Visitors come on the floor. Bob, why don't I just put all my money in almost 5% one year and forget about the stock market? Who wants to figure out the stock market if I can get 5%? There is a problem with that reasoning. There's nothing wrong with putting money into short-term treasuries right now, but be very careful. 5% sounds great, but if inflation is 6 or 7%, you're still losing money. It's an illusion in your head. You're only making more because inflation is notably higher. And if you think that you're necessarily winning a game, you would only be if inflation were to come down quickly. Otherwise, you're still net negative. So remember that. The second thing that happens here is you have what is called reinvestment risk. What's that? Well, you buy a one-year treasury and you got your 5%. 1 year from now, you're going to get your money back. Now, what are you going to do with it? This is called reinvestment risk. You may be unable to turn around and put that in 5%. It may be only 3%. It could be 6%. The point is, you don't know, and nobody knows. You might have a better opportunity to have done something else with it. So the short answer to how to deal with this is keep a balance. Don't sit there and try to trade your way out of this. That's a crazy idea. You understand what you want to own, a balance, a real estate, like your house, stocks, bonds. What balance should you have there? What kind of alternative investments would you want to balance? A stamp collection, a comic book collection. I used to collect comic books. And how do you want to balance those assets? How old are you? How long are you going to live? So let's be particular. Let's get personal. I'm 66, 67 years old. I think I'm going to live to 90. How do I know? I don't know, but I'm reasonably healthy and I'm going on certain demographic knowledge that I have. People who live past 65 have a very good chance of making it to 90. Not everybody, but I'm optimistic. So there you go. I just made a guess. And so I'm going to have 24 more years, pick a number to live. So what does that mean? Well, I have a certain amount of money in stocks and bonds, a house. What does that mean? How can I balance that out? I'm not going to sit there and trade in and out of one-year treasuries for the next 25 years. What, are you kidding me? I don't want to play that kind of game. So I have a certain balance. I wrote a book, Shut Up and Keep Talking. In the book, there's a chapter where I describe my entire investing journey for the last 30 years and what I've owned and what I own now, or at least what I owned as of December 2021 when the book was finished. So you can find out what I actually own, and it hasn't changed much at all since, it's been a year and a half now, almost. And you can find out, but it's a mix of stocks and bonds, and it's mostly index stuff. It's not very interesting or fancy. My biggest holding is the S&P 500. So I always say that to people, rich, poor, long-term, short-term, owning the broad market, the S&P 500 and some bonds. No one will ever laugh at you and say you're an idiot. Nobody will ever do that. So understand your risk tolerance. How much can you stand to be able and own and be able to sleep at night? I happen, and I've said this in the book, 75% of my investment portfolio is stocks now. And you might say, well, that's high considering you're old. You could die, or the market could go down like it did last year. And I believing that I'm going to live the next 24, 25 years, I'm not worried about what happened in 2022. So I'm only giving you my personal opinion. But professionals who come on CNBC repeat the same thing over and over. Understand your risk tolerance, have a diversified portfolio are the key things to understand.
Yeah, for sure. It's definitely important to keep that long-term perspective on things. So thanks, Bob. And then last question, what are you watching in the week ahead? What should investors be watching in the week ahead?
Well, again, this inflation story is going to be very big. So the Consumer Price Index, the CPI, is going to be out next Tuesday. The last one, I think, was 6% or 6.4%. So there's my point. Everybody who's, you're loving buying 1-year treasuries at 5%. Inflation is 6.4% last month, year over year, CPI. It's expected, I think, to be 6% again. So there you go, folks. So you want to watch that. You want that to go lower, okay? If we get a number in the 5s, generally, all other things being equal, that's really good news. The other thing is this bank story. Bank deposit risk, and there are some questions. I think the government's going to be very active here. They shut down Silicon Valley. People who are had deposits there are insured up to the federal limit, but the regulators will be watching if there's systemic risk, and it's the small banks you want to probably watch to see if anything goes on. So that'll be kind of important. The other thing that's important, it's interesting, is there's a rebalancing in the S&P 500 indexes and in the MSCI indexes next week, and this happens once a year, and then it goes to highlight the importance of indexing. So S&P keeps the S&P 500, and they make changes in that index every once in a while, like when we say energy stocks are moving, or consumer staples, or consumer discretionary are moving. Why do we call them that? Well, there's a convention, a naming convention. S&P and MSCI have an agreement of what to call all these things and why are things classified, and they're moving things around in the indexes. So, for example, Walmart is a consumer staple stock, but Target, which kind of sells similar things, and Dollar Tree and Dollar General, similar to Walmart, they're actually consumer discretionary stocks. That never made a lot of sense to me, and they're actually moving that. They're putting Target, Dollar Tree, and Dollar General into consumer staples along with Walmart. That makes sense. And some big technology names, Visa, MasterCard, and PayPal. Now, these are financial companies. Visa is a credit card company. They've always been called technology stocks. Doesn't make any sense. They're moving them into the financials. So technology is going to get smaller. Financials are going to get bigger. And this goes to the power of indexing. 30 years ago, this was all academic. Nobody cared about any of this stuff. Now there's trillions of dollars indexed to these funds. The S&P 500 alone has $7 trillion indexed to it. And there's trillions more people who try to match the S&P 500 in their performance, but they don't pay the S&P a licensing fee. So there will be $10, $12 trillion indexed to the S&P 500. The value of the S&P 500 is about $32 trillion. Think about this. I mean, more than 20% is indexed to the S&P 500 directly, the value of the. So these changes in indexes become very important because money moves in and out, and people own the indexes, and they own the sectors inside them. They'll own energy stocks. So if a lot of energy stocks suddenly go out or come in, then the portfolio changes and the performance of the portfolio changes. So I know this sounds a little academic, but actually now that everybody's become an indexer, it's become more important. So I'll have a trader talk out this week that kind of explains it a little bit, but you get the point. And by the way, you can look at my trader talk every day. It's on Twitter. I also put a little summary up on Twitter every day at Bob Pisani.
Thanks, Bob. Yeah, definitely, as always, check Bob out online, Trader Talk, and at Bob Pisani on Twitter. Thank you to everyone for sending in your questions, as always. We love hearing them. And thanks, Bob, for answering them. Appreciate it.
Thank you. Good questions, everybody. See you soon.
All right, talk soon. Bye.